So, more people than ever are working gig based jobs. This includes those who drive for Uber, Lyft, people who perform on OnlyFans, DoorDash, the list goes on and on. You all know the companies that I'm talking about. The largest demographic of people working in these types of industries are those who are in their 20s or 30s. They've probably never owned real estate, but they need somewhere to live. Rent is getting exorbitant, and they're ready to buy their own house. So, how does that work when you're a 1099 gig worker needing to qualify for a home loan? Well, it's not that difficult. Let's go over it. So, like any self employed individual or independent contractor, these types of people get what's called a 1099 at the end of the year from whatever company they do the work for. Whatever dollar amount is listed on that 1099 as income then goes on that person's tax return, usually in the form of a Schedule C for self employment income. And they'll write down how much they made, and then they'll deduct all of their expenses. So somebody who drives for a living is going to deduct expenses associated with wear and tear on their car, fuel, maintenance, things of that nature, and they're going to come up with a bottom line net profit after their income minus expenses has been tallied. This is the number that a mortgage lender is going to use to qualify for a loan. In a lot of cases, that number is quite small because there are a lot of deductions that can be made. That's okay because a lot of those expenses or some of those expenses can actually be added back to your income to show more on paper for the mortgage company. A good example of this is depreciation. Say somebody has net profit of $40,000 at the bottom of their tax return, but they claim $20,000 in depreciation. That can be added back, so the income for mortgage purposes goes from $40,000 up to $60,000. But what if the add backs don't help you qualify for a loan? What if the income is still just too low? Well, we have a solution for that as well. We can offer what's called a bank statement loan. Bank statement loans are for self-employed individuals who don't show great income on their tax returns, but you can see money flowing in and out of their bank account from their business. Usually we need 12 consecutive bank statements. Sometimes we'll ask for 24 months worth. And what we do is we'll average the deposits and plug those into our formula to come up with your qualifying income. Now, a bank statement loan is going to require a substantially higher down payment than that of a loan that would look at your tax returns. This is to mitigate the additional layer of risk involved. You're also going to be subject to higher interest rates, but bank statement loans are a great way for self-employed individuals to get into the house. So those of you who do work in the gig economy, don't think that your job is going to prohibit you from buying a house. You may very well still be able to qualify. If this is something you want to pursue, I would recommend connecting with a local mortgage broker and discussing your options.